Charles, there's a lot of volatility in the market these days. What are your thoughts? Is it going to get worse before it gets better?
Probably. If we're saying volatility, but remember, volatility is not always down. It's up as well. The definition of volatility is just standard deviation. And I think there's going to be no shortage of volatility for the foreseeable future just because there's so much uncertainty with what's happening with all these different policies. Tariff, no tariff, taxes being put back to where they were or staying where they are, getting better or lower, depending on your perspective. So I do think the volatility is going to continue. Whether that volatility is up or down, we're less certain on that. And I think no one can be really certain on that.
So what are you doing to manage volatility in your client portfolios? How are you putting your clients at ease?
Absolutely. So we do two things. Well, one thing we've always done and one thing we're doing more recently. So the one thing we've done always is lead with financial planning. So we feel that it's important for us, if we're going to do any kind of asset management, to understand two things. When does that client need the money back and how much do they need, right? How much do they need to college or pay for college and when is that? How much do they need for their down payment and when is that? So on and so forth. And then we create sub-portfolios for each one of those. So we have one for money is needed in 1 to 2 years, 3 to 5 years, 6 to 10, 10 plus. So that way, when the market is down, that 10 plus will take it on the chin, obviously. But the 1 to 2, the money they need in the short term, is safe and secure. And I think that's the only way to do it.
Can we dig a little bit deeper about vehicles which help wealth managers manage volatility? Because there's a lot of them out there now. There's buffered ETFs. You can use options. You can use long-short strategies. What are your thoughts on those?
Sure. So of the different types of hedges one could use, the best one is one we're already using, or most managers do, which is diversification. Right? Diversification is like the OG of hedging, and we use that all the time. What we are starting to pepper in more, though, are some of these products that you're mentioning. So structured notes. And a structured note is nothing more or less than an option strategy that's prepackaged for you. For larger clients, we're also doing option strategies directly, and we're also looking at some alternative investments as well.
What about that crazy asset class called cash? Does that work too?
You know what? Here's the good news. With rates going up or having gone up, cash is pretty attractive right now. So we don't believe in market timing, so we will never wholesale get out of stocks and into stocks. But if we are going to get a little bit more defensive, and frankly we are, right? We don't market time, but we also recognize the volatility. And if we can get 4.5% in an FDIC guaranteed money market, which we are able to get, will we raise our cash exposure? Yes. Will we bring it to 100%? Never. But how we brought it up in a meaningful way, we have.
And then finally, back in 2022, we saw stocks go down and we saw bonds go down. There was a big move into alternatives.
Yeah.
Is that a smart play as well?
I think it is. Again, it's another way to diversify. Nothing is the silver bullet, right? So we are actually launching an alternatives fund, which I can't talk about in detail yet, according to my compliance officer, but we would love to come back to talk about it. But it's not so much that's the answer, but it's part of creating that mosaic, which is a portfolio, and you're more diversified. And historically, these alternative investments like the private credit, the private equities, have shown a lower standard deviation, lower volatility. And in times like this, that sounds pretty good.
All right, well, thanks for coming on and talking about it.
My pleasure, Greg. Always great to be here. Thanks.